In the previous section, I skipped several slides related to the details on IRBB. And this is particularly the case of the underlying methodological treatment, how to calculate net interest income sensitivity, how to calculate EVE volatility, and how to calculate the basis risk exposure of a bank. I have also included a case study for you. If you want any free time, you can spend some time on this. And if you have any question, please email me so I can help you and explain if it's not fully understood. And then I have skipped also the part related to the regulatory treatment, which is Basel Committee on Banking Supervision. You have the presentation for your disposal. If you want to have a read, then you will find those details. If instead you prefer to refer to the IRBB webinar where all those details have been treated separately. Here, for the sake of time, I couldn't go through all of them because IRBB is an ocean. It is so big topic. And with the new regulatory challenges, it is becoming bigger and bigger, and so many things there are to be discussed and analyzed. So it has to be the separate section during which we will be speaking about the methods, about the flows approach, about the stock approach, how to calculate the credit spread risk in the banking book, how to quantify the basis risk exposure. All those things will be separately discussed in the IRBB webinar. For now, however, I would like to touch base on the global interest rate risk practice. This is the presentation, this is the slide which you have right now in front of you. And as you can see, we have the two types of banks. We have the type 1 and type 2. And the first one, it can be globally seen in Europe and UK, and the second one in United States. So what does it mean, this type 1 and type 2? Basically, we know that in IRBB we have two different views. We have the internal view, which focus on the interest rate risk, which is left under removing the product margins. So we only take into consideration the small interest rate risk portion, which is the part of the all-in rate for the client. So you can imagine that in the FTP rate terms, it will be the component which belongs to the IRBB. So it is the risk-free rate, it is the base rate, it depends, base rate component on of the FTP, it is how you call it. And when we strip the commercial spread fund, the commercial spread component, which is definitely impacting on your total economic value of equity, if you keep it, and if you don't remove it, because it is inflating your banking book value. If you discount it with risk-free rate, for example. So if you discount it with OIS curve, or if you discount it with government curve, whatever curve you use for discounting all your items on the banking book, if you don't remove the commercial margins, then you risk to inflate the banking book of the bank. And it is really high inflation. Imagine that you have the commercial margin of 5%, and then you discount it with the low rate, because in this environment of the low interest rates or negative rates, we discount with the small rate, and discounting factor is very small. So basically you have the value of the whole banking book is inflated, even though it is not the commercial spread which you will be aiming to hedge. So this view or needs to be, or you apply the internal view, or you apply the external view. So this separation needs to be clear. And in case on the internal view, as I said, for FTP, we split it and we remove the product margin. And we discount, therefore, with the risk-free rate, discounting rate. And if not, we have the external view, we keep the product margin because we want to calculate the overall net interest income, also of the expected cash flows. So it is the future net interest income, but we discount it also with the curve, which is adjusted by commercial spreads. So by commercial margins, it is not risk-free curve anymore, because as I said, you would inflate the value of the banking book. And obviously for NII, this is the case only for the calculation of the economic value of equity. You can see here in the lower part of under management of the interest rate risk in the banking book from NII and EVA perspective, we see that under internal view, we have the EVE, which is calculated through removal of the commercial spreads. Obviously, NII is calculated taking into account the all-in rate, so you don't remove any commercial margins because you want to understand your total NII. And then for the external view, you have for the economic value of equity, you calculate including the commercial margin, but remember in this case you have to adjust the discounting factor. And NII is obviously calculated keeping the commercial margin and taking it into account. So this is important to have this split in mind. I had the in the previous company, we had this debate in my previous company for which I used to work. We had the debate related to external versus internal view. And then we discovered that when we apply the adjusted discounting factor, adjusted term structure of interest rate, you effectively more or less arrive to the same value, which if you remove the commercial margin and apply the OIS curve, so the risk-free curve. So it is important that we have it in mind. And let's focus on the type 1 banks. So as previously said, they aim to fully hedge the economic value in the internal view because they remove it through the FTP and transfer it to the central unit, to ALM, to be managed on a daily basis, because you are watching the ALM or treasury desk is watching the market environment and monitoring the economic value movement of the bank and treasury book. They have to be sure that there is no excessive exposure on the daily basis. So quite often, if you have the big portfolio and you apply VAR dynamic metrics for IRBB, then even more you have to recalculate it on the daily basis because the market risk factors are changing on the daily basis, or even more frequently during the day as well. But you at least calculate it on the daily basis. And being in big international banks perform the NII simulation on a monthly basis. I've included the session. This is not exactly the webinar, but this is the example of an asset liability management report, and which metrics are calculated for the purpose of the monitoring and communicating to ALCO. And you can see that this NII simulation can be performed under a number of different scenarios, and it can be forward, it can be scenario which you want to use for your own purposes because you think that it can happen to the market. So you can apply historical also one, you can apply upward, downward, and this is something which you will be simulating on a monthly basis in order to detect any possible margin compression risk. So you will definitely calculate the scenario under which you are better off, and then you will assess the probability of this scenario occurring, and you will try to position your bank in such a way in order to be as close as possible to the best scenario, and to keep the gaps in such a way that dynamically manage those gaps in such a way that that the bank has the higher value, economic value, and gain is embedded gain in the banking book. The common metrics are NII volatility. NII volatility is the short-term metric. It can be or static or dynamic. For the static one, which is very extensively described in the Basel Committee on Banking Supervision document, you have the in appendix, you have the calculation algorithm. So you calculate this, and then on the medium long part you have the EVE and a number of different interest rate scenario, but you want to apply the separate economic value metrics for available for sale portfolio, so for liquid asset buffer portfolio, and you will for treasury book portfolio, and you will apply the parallel shifts, for example, or use 94 crash scenario, apply historical scenarios in order to understand what happens if the curve is going down or if the curve is flattening, and all static metrics has to be implemented. Plus, additionally, if you are sophisticated international, even medium size institution, financial institution, that it is very desirable to have also the dynamic metrics in place. By dynamic metrics, I mean value at risk, earning at risk, where you obviously you need some time series, you need the market factors, and then it is better practice to focus on both static and dynamic view. As a static method, it is always important to have a view of the repricing gaps and the forward scenario and the constant volume scenario in order to see if we are asset or liability sensitive on the short part of the curve. And instead, for the bigger banks, it is imperative to have the dynamic simulations. So this is performed usually by the system or through Monte Carlo simulations, and then you will report it to the ALCO. And in this dynamic, it's not only the curve which is changing, you also will change the composition of the whole banking book, the size of the balance sheet, and its estimated growth, and the rates, client rates on the deposit base. It is all which you will be assessing, and it will be more stochastic analysis rather than deterministic. And the bank should have the economic value, economic earnings at risk and economic value of R for the banking book. Very common as I said, in the bigger bank, it is the case that you have all dynamics, a suite of metrics, and all static. And static are obviously the repricing, refixing, the EV, economic value of your treasury book, and I would say duration gap, which is measuring the extent of the riding the yield curve. You would have the time bucket sensitivity. You would have a present value 0.1, PV 0.1, total PV 0.1, which is important metric as well. And then you will have at least those two dynamic metrics, so earning at risk and earnings at risk and value at risk for the banking book, so the whole banking book. Even though there is the dispute how good is the value at risk applied to the whole banking book, but this is a different story. And subsequently, let's have analyze some observed market practice. Obviously, there is a very big focus currently on the stress testing and reverse stress testing, scenario analysis. And the recent Basel, not only Basel, but EBA requirement points out that the stress testing part has to be developed and has to be applied to the IRBB. So we need to look at a number of scenario rather than just the shift by 200 basis point up and down. And then we have the measurement assumptions, which, as I said, IRBB should be based on robust assumptions. So all the assumptions which relates to the deposit characterization model. So by this I mean the current accounts and savings account modeling, so the stickiness of those products, the pass-through rates estimation, the volatility of outflows for those products. This is exactly what we mean by the assumptions. We have also assumptions for the rollover of the time depot, and we have the assumptions related to the haircut on the liquid asset buffer portfolio. We have the assumption related to the withdrawal of the credit lines, drawdown on the credit lines, early redemption on time depot. We have also the prepayment. Those all assumptions has to be documented and tested and recalibrated and validated. There is the strong emphasis put by the EBA regarding the model validation practice. So you have to validate by external part. It will be all the internal unit, which is separate, which is not and the same in the conflict of interest for the model owner with the model owner, because it is the model validator or model checker, and then you have the external party, which is just can be a consulting company or who is validating your model from both qualitative and quantitative point of view. So is it robust? Is the assumption, the model are robust? If the technique apply is correct, and all this stuff has to be basically on at least annual basis revised. And then we have the methods for the measuring of IRBB. This is something which we spent already quite a lot of time to discuss it. And we have the governance of the interest rate risk. So the IRBB strategy. This is the portion which I skip, and you will find several slides regarding to the IRBB strategy. And you can't even imagine how important is to have the robust and sound and aligned with our business model IRBB strategy. You have to have it written down in your bank, so you know what is the strategy of the bank in terms of riding the yield curve, to which extent you want to ride the yield curve, or you maybe don't want to ride it at all. What is the amount of the potential unhedged position which you are going to keep within the banking book? This is whole part of decision which needs to be made by the board of directors. And then we have the risk policy, the interest rate risk policy. We have the processes, controls, including, as I said already, validation, the audit, which covers all sensitivities, impacts of scenarios. And we have the reverse stress testing, which is something new included into the IRBB suites quite recently. Probably it is coming together with the revised ICAP methodology, where we have it is a part of the delivery for the all IRBB package, so what has to be submitted to the regulator in April for the ICAP, and this methodological treatment, methodological overview, how you want to approach the reverse stress testing is written and is well documented. So what is exactly reverse stress testing? It is something which it's the scenario you're starting from the end. So you want to breach the limits, you want to put your bank at risk, you want to breach your capital ratio, you want to put it down basically and breach the regulatory limits and expose to the extremely unfavorable scenario, which is exactly calibrated to your particular bank situation, and what needs to happen in order to have this scenario in place. So, for example, what needs to happen into the interest rates, in order to breach the regulatory limit, or to breach the capital ratio, or to let's say absorb all the capital which we have in the bank because of the losses coming from IRBB. So this is the reverse stress testing. And this is the summary. As I said, interest rate risk is the central risk factor within the risk management framework. And we have the problem of lowering of interest rate 0 and coping with negative rates. And this is something important, that the new regulatory arrangement has new regulatory guidelines, has removed the 0 floor. So in the model, you will go below 0. And currently it is from minus 100 basis point to 0. So you can go down for the short part of the curve by the quite extreme amount down, and then it's slowly increasing. So this negative portion is being reduced. So this is exactly what the banks are doing right now. They construct the models which allows the negative rate in the environment. You have at least 7 or 15, even from 7. There is the range of scenario which the banks are providing for the sake of the IRBB calculation. It is from 7 to 15, and instantaneous shock for economic value, continuous for net interest income, and this parallel historical scenario, usually for the VAR, banking book VAR, calculations have 1,500 scenarios, so it is quite a lot. Let's talk about now, once we concluded the topic of IRBB, I would like to discuss the liquidity. As I said, liquidity is the second big financial risk of ILM, which ILM needs to manage. There are two types of liquidity risk, I would say. The first one, because we need to split it between liquidity risk and between the funding risk. The first one is the risk that you won't manage to sell your liquid asset buffer at the price which you have calculated, or which it is the market value of those assets, but you need to apply some haircut in order to get funding, and the price is extremely unfavorable to you, and you will lose money. This is the first risk. This is known as the liquidity risk, market liquidity risk, when there will be the impact on liquid asset buffer, and you won't manage to sell it at the price you thought you will be having, the money you will be having from the sale. And then you have the funding risk. Funding risk is the second part of liquidity, because it is related to the ability to roll over funding in the future at the good competitive rate and not at the rate which is increasing due to the different factors. It can be the factor which is idiosyncratic, related to the mismanagement of the bank and related to the increased cost of funds for the bank in the industry, or it can be higher because of the market. So just market, all the market is has the higher cost of funds. The riskiness is perception of riskiness of the banking industry is higher. So it is something which will impact on the cost of funds. And those two risks has different metrics. So the banks, again, like in case of the interest rate risk, you look at the dual view between the short part and the medium part. The same is valid for the liquidity. In the liquidity management, you have the tactical liquidity, which is the liquidity managed on a daily basis in terms of expected inflows and expected outflows, which are estimated by the treasurer. So they are tactical, they are very short term. They have to predict how much money they need within the next 1 week, or how much they will disburse because of the new transaction they are going to put in place. All those calculations are performed by the treasury desk, and the simulation of the cash flow, expected cash flow. There is also the stress test calculation. So you have this liquidity asset buffer and you have the regulatory metric for this. This regulatory metric is known liquidity cover ratio, which estimates the necessity of how big your liquid asset buffer should be. Liquid asset buffer, so high quality liquid asset, how big it should be in order to cover all potential outflows which could happen under stress scenario within the next 30 days. So this is what LCR is trying to estimate. And then you have the short-term ratio, cumulative ratio, which we'll be seeing here, which again is calculating the mismatching between the inflows and outflows, and how much by the time bucket you would need to have, how much this coverage should be of your outflows by the inflows. Is it 100%? For sure in the short part, because short-term liquidity is referred to be 1 year. So you divide it by different time buckets, we'll see it later. And then in the short part, definitely within the first 30 days or 45 days or whatever time frame you decide to apply to your bank. So this survival horizon, this is the time frame which needs to be covered fully, or even higher than 100%. It's 120, it's 130. Some banks even have 200, and I've seen some of those who had 600. And this is the problem, because you then have the problem of the excess cash, which is in the current environment extremely expensive. So you don't want to run the negative cost of carry, which is coming from the negative rates, and which is coming from the fact that you cannot deploy your deposit or your cash in your capital into something which don't bring you enough value to cover for this cost of funds. And this is exactly what do you mean by negative cost of carry? So you run the negative cost of holding those assets, and basically this is the big debate in FTP, who should hold these losses which are coming from lab. Is it ALM, or should it be distributed across the business units, or should it be just sitting within ILM, and ILM should be, let's say, responsible for those losses? Those are all questions which are analyzed under FTP framework. And then you have the longer, medium, long-term metrics for liquidity, which are known structural liquidity. So the structural liquidity, at least you have two metrics and one regulatory. And structure, what does it mean, structural liquidity? Structural liquidity is the liquidity which with the residual maturity, all items with the residual maturity higher than 1 year. So this is for this reason it's a structure, because it is, we are talking about stable funding and non-liquid asset. And we are asking for a basic question: how much do I need of my stable funding in order to cover my medium long-term asset? Do I need to keep 100% of this asset needs to be funded by stable funding, or is there any possibility to have some small mismatching in the terms that some portion of those funds, of those assets, will be funded by short volatile funding? And for example, short-term items are mainly funded by short-term liabilities. And at least you assume that, for example, the liquid asset buffer is funded on short-term basis. Let's have a detailed look through all those liquidity metrics and what do they mean.